Ms. Freeman joined Clearlake in 2020. Prior to joining Clearlake, she was a senior vice president at EIG Global Energy Partners, where she was responsible for managing investor relationships and products globally across the platform. Prior to EIG, she was a director at Invesco, where she was responsible for marketing private equity and debt funds, and for Invesco Private Capital and W.L. Ross. Prior to then, Ms. Freeman was an associate in the office of the chairman at J.P. Morgan Chase. Ms. Freeman serves on the board of directors of Florida A&M University Foundation and the National Association of Security Professionals. She is also a team member, the Council on Foreign Relations. Ms. Freeman received an MBA from Harvard Business School and graduated with honors from Florida A&M University with a BA in finance. Next slide. Randall Leith Jr. is an alumni of Florida A&M University and currently works as an investment research associate at Wellington Management Company, focused on financial technology. He specifically focuses on payments. We could give a virtual round of applause for our speakers. Take it away. Next slide. Thank you, Ms. Freeman.
Great, thank you. So I am joined by, I'm Marcelia Freeman. By the way, they spell my name a little bit wrong, and I know it's a really hard name to spell, but it's Marcelia. And I am based in Los Angeles, California. I work at a company called Clearlake Capital, and we can talk more about what that means and what I do. But I also want to acknowledge my co-host, Randall Leith, who is also from a graduate of the illustrious Florida A&M University. I saw Lanaya in the comments. Hey, Rattler. But it is such a good and wonderful feeling to be with all of you, whether you went to an HBCU or you are a UNCF scholar or otherwise. It's a pleasure to have you guys this afternoon. And what we wanted to do was spend the next few minutes, hour, or however long we have you, talking about investment management, talking about the importance of people like you and me and Randall in the industry, in the impact that we can make, and then also just answering questions about our career paths, our education, whatever might be helpful to you as you think about careers in investment management over the summer and think about interning in investment management next year. I'll pause and let Randall say hello.
Appreciate that, Marcelia. So first off, I am Randall Leith Jr. I am a freshly graduated alumni from the Florida A&M University. I'm currently working at Wellington Management Company as an investment research associate. I've actually been working at the firm for the past 2 years in a full-time internship capacity, and really just excited to get started in the actual world itself and really explain to you guys my passions, my interest, my drive for why I got involved in the investment management industry. So appreciate it.
Okay, great. So we'll save some of the why us for a little bit later, but first we'll kind of focus on what actually is investment management. So if you would advance to the next slide. Oh, a couple of our pictures are gone. There we go. Okay, so you see kind of words thrown out here and there, whether it's Wall Street or Main Street, whether it's money management, whether it's buy side, whether it's fiduciary responsibility. People tend to throw out a lot of these words. These are all kind of synonymous with investment management, managing money on behalf of other people. Now, we all manage our own money. But that could be called budgeting. That could be called personal finance. But when you manage money on behalf of someone else and you invest on behalf of somebody else, you are uniquely participating in the world of investment management. Now, there's a lot of different ways that you can invest money, and we'll talk about all of that. These books and movies all represent different ways that people participated in the financial markets, whether it was Reggie Lewis, and I definitely suggest that you guys read this book, Why Should White Guys Have All the Fun by Reginald Lewis. It is a fantastic roadmap to how to become a successful business person, particularly when you look like me and Randall. I highly suggest you guys put that on your summer reading list, or Barbarians of the Gate, which was really about the beginning of the private equity industry. And I'm sure you guys have all heard about venture capital and private equity, and we'll talk a little bit more about that. But all of these books and movies kind of represent investment management, but we will actually talk about what actually is investment management aside from managing other people's money. So if you'd advance to the next slide for us. Thank you, Akila. So this page, gosh, I didn't realize there was so much animation in this deck. I never put animation in decks. I always make PDFs so that I don't have any animation. I don't want any creativity around me. If you would kind of advance all the way through so we see the full picture. I am going to Perfect. Thank you, Akila. I'm going to give you guys a very high level overview of the financial services industry. And Randall, given he's had a little bit of time in the industry himself through internships and what he's done personally to advance his own understanding, I'm going to let him chime in as well. So, at the end of the day, there are kind of three main parties in the financial services industry. People that need capital, or institutions or organizations that need capital, folks that have capital and can provide capital, and the financial intermediaries that make sure that that capital goes to in between those two sets of parties. So users of capital, they could be entrepreneurs, people that are starting up a business, like, maybe some of your classmates might be. They could also be, more formal entrepreneurs that are starting big businesses, million-dollar businesses that need a big balance sheets. They could be corporations, well-established companies like Apple, like Nike, like Raytheon, or they could be governments like the city of Atlanta or the country of China. All of these folks could be needing capital, and there are sources of capital that they can tap into. They go to banks, they go to insurance companies, and they go to investment managers in order to access that capital as kind of a third party, an unbiased third party provider of that capital. They go to these financial intermediaries, but the financial intermediaries are essentially funded by governments, all the same types of governments I named, corporations, and even what we call Main Street, or people like you and me that have extra savings or want to invest, and we provide capital to folks that need it for the right risk return spectrum. So I will pause there, and I will let Randall chime in on kind of the other parts of the financial services industry, like stock exchanges, like securities, and so that he can kind of share what he understands about that with you as well.
Definitely, yeah.
I gave him the hard part.
Yeah, no. So first off, again, I'm Randall Leaf, you guys. And so when we think of stock exchanges, really another form of intermediary of how we buy and sell securities. And basically, it's a form of secondary market rather than the over-counter market, which you can go into more depth in later through Investopedia. I'm going to throw out a couple of terms for you guys. Just remember that Investopedia is going to be your best friend, especially in this industry. But when you think about these stock exchanges, these are going to be the largest drivers of capital throughout the entire industry. They're going to be driving equity. They're going to drive actually it's primarily equity when it comes to this. Stuff like bonds. You won't really see that in you only see that more so in the over-the-counter markets, but you'll see a lot of Bloomberg terminals that will be trading bonds and stuff like that. And you'll get to know a little bit more about Bloomberg terminals and other kinds of technology in regards to the financial services industry. And then other tools that we are going to provide to you. So like products that we offer to you in regards to generating alpha, ways that we think that you can actually utilize the financial services industry to really best equip you for the future. So like if you're trying to retire at 35 or trying to retire at 40, 50, I know this is a short timeline, but retiring at any of those ages, you're going to probably be offered one of these products from the financial services industry and saying, hey, you want to buy some index funds? You want to buy some stocks? You want to buy something like this? So these are going to be your financial intermediaries and how they're really going to work through, financial service industry and the financial intermediaries and how they're going to really work with you in regards to allocating capital efficiently and effectively. So think about that. And then also a little bit more about the banks. Banks take your money. Well, not take your money. You actually deposit your money in the banks, and the banks really give you a return or required rate of return for the amount of money that you're actually lending to them on their behalf. And they'll actually use that capital and lend it out to other people who need it. So these are your capital users. And that's really where the securities come into play, because the securities give that return back to the investors or the capital providers to really put right back into the market. And you can see how the whole cycle really goes into itself.
Maybe the one thing I'd add here is that there is a concept of risk versus return. And so if I am a risky borrower, I don't have a good credit history, I've never really borrowed money, or I've borrowed money and I haven't paid it back, I'm high risk. And so somebody is going to require me to pay them a higher rate of return or higher interest rate in order for them to lend me money. It's not that different when we think about risk versus return for investing. So if I am going to invest in a sure thing, a business that is steady eddy, that's growing, that's sending me cash dividends back, and it's not growing a lot, it's making widgets, but it's making the same widgets decade after decade, it's a pretty low risk and low return investment. On the contrary, if I am investing in an entrepreneur who has a great idea, but maybe they don't have a great track record of creating something, maybe this is their first time, or maybe the first time they did something, it didn't go as well as they wanted, that is a higher risk investment. And so households and corporations and governments and other folks that are investing in that will require a higher rate of return. So the higher the risk goes, the higher the return is expected. And similarly, if something is low risk, like putting your money into a bank account, you know it's going to be there. And so there's not a lot of risk there. And so the return that you get will be pretty low. We can dig into the risk return spectrum a little bit more, but essentially one for one, it goes up, risk goes up, expected return goes up, and down the same way. So that is something helpful that I want you guys to remember as you think about capital providers versus capital users and the requirement of return versus risk that is being laid out. Akila, if you would go to the next slide, please. So we are going to kind of march through these terms really quickly, but these are all things that I want you guys to dig into a little bit more, and I think you'll get these slides afterwards. So as you Google sell side, as you Google buy side, a whole world of information will open up on each of these topics. And so with that, I'm going to pause and I'm going to let Randall go through the first few terms because he knows this stuff like the back of his hand.
You flatter me. I appreciate it. But yes, so let me go through the terms, sell side and buy side. So basically, I deal with a lot of buy side. I mostly work on the buy side since I'm Wellington Management Company. We are a $2 trillion asset manager. Let me not put myself out there yet. But hey, no. So I actually work at a buy side firm. So we're actually the capital providers. We purchase securities on behalf of our clients and hopefully generate the returns that our clients really wish that we have. And we're basically acting as a fiduciary in our clients, really how to say it, acting as a fiduciary in regards to our clients, in regards to ensuring that they are putting their money where in the most effective places for their current financial position, right? Not actually a financial advisor, that's a completely different spectrum of things. We're just in the actual acquisition of the securities themselves. Sell side, those are actually the people who will provide the models, the Excel spreadsheets, the reports, the price targets. Basically, that's kind of your mark of the market in regards to where's everyone thinking about, where's Wall Street at. Your sell side firms are going to be pumping out a lot of reports and just overall information about, hey, these are the instruments that are currently doing well. Here's what's doing well in the market. And it's kind of a area where you'll be most abreast of the current events that are going on, everything that's happening right now. A little bit more, again, current events driven. Buy side, I would say, it depends on the actual shop that you're in. You'll be either in a hedge fund, you could be in an investment, you can be an asset manager, you can be in a private equity fund, you can be in all these types of funds, right? I could go through tons of these, of course, but you could be in all this entire spectrum of things. But at the end of the day, their investment horizons are a bit different. So they actually could be looking at a couple years in the future, it could be 30 days in the future, really, or it could be 20 years into the future, like my firm looks at. So just understand there's a lot of variability when it comes to buy side and sell side, although they're a little bit more absolute on the sell side in regards to current events and their timelines in that retrospect. And then
I'm going to chime in here. So typically sell side firms are investment banks. So when you think about the investment banks that come to campus, whether it's Goldman Sachs or Citibank or JP Morgan or Wells Fargo, sell side typically means investment bank. Sell side organizations or investment banks are creating financial instruments and they're selling financial instruments on behalf of the users of capital, the people that actually need capital. Buy side organizations, that usually means investment manager. That's usually the word. So investment bank versus investment manager on the buy side. Those are the folks that are buying financial instruments and they're buying them so that they can invest. So buy side equals investment, sell side equals creating and selling. It's an easy way to think about using it. And buy side firms usually interact more with capital providers, whereas sell side or investment banks typically interact more with the people that need the capital or capital users. Randall, please go ahead. I chimed in when you were going to.
No, you're all good. And I mean, there's also additional things to add into sell side. Is like, you'll hear the term underwriting all the time on the sell side. When you're underwriting security, you're basically going out and selling everybody the dream of the security. You're trying to work on behalf of the company that is issuing that security to obtain investors and ensure that the capital is being allocated properly and that people all have an opportune chance. Well, I can't say everyone has an opportune chance. We're talking about accredited investors have an opportunity chance. So aside from that, that's kind of what you would think about in the sell side. They are going to be the people who are selling those securities on behalf of the firms, like she had said, like Marcelia had said. And yeah, underwriting would be similar to creating on that side. And also a lot of firms actually earn commissions for underwriting these securities. So that is one of their largest revenue generators for the business itself. And so then moving on to security. So as you can see here, they're basically financial instruments that can be bought or sold in public and private markets. So think of a share of a stock or a share in a private business that you could currently own. These are what we would classify as securities. I'm only saying shares because it could be stocks, it could be bonds, it could be preferred shares, ETFs, all these other types of financial instruments that could be going through the actual process of the capital structure for the business. So thinking about these securities, these are the methods for how these businesses are actually raising capital. And why businesses raise capital a lot of the time is so that they can operate more effectively and more efficiently and work as their mission statement really it was intended to work. So that's really what you're doing when you're buying securities, buying and selling securities. You're buying into the mission of that company, that business, or buying into the already established business itself and expecting a return for believing in that mission and creating a story for that business itself. So that's what securities kind of outline in a little bit of a layman's term. And then being a capital provider. These will be your individuals or your institutions that are like your high net worth individuals, really wealthy individuals. Actually, you could also be a capital provider right here yourself. But typically when you're saying a large majority shareholder, you're saying somebody who has large amounts of wealth, or you could be an institution who pools capital on behalf of multiple investors, such as like Vanguard, you got the BlackRocks, a lot of other financial institutions. I mean, you can go into private equity about Blackstone, all the other all the other firms that are out there in regards to being capital providers. Oh, sorry, I'll answer your question afterwards. Actually, Zion, my bad. I was looking at your question, but these can also be, again, you yourself, the corporations, pension funds. If you don't know what a pension fund is, basically it is the retirement benefits that your parents or whoever is in your family and is living to old age has to really cash in, and this is their money for working so many hard years. So we take pensions very seriously, especially in the investment management industry, because we're literally managing money for people's futures, like trying to ensure their livelihoods and make sure that they can live a comfortable life. And then also nonprofits, we manage a lot of money for them in regards to investing and ensuring that they can operate in their nonprofit capacity and not have to worry about generating revenues themselves. So that is how really we would go through capital providers, securities. But I'll go and pass it off to Marcelia for capital users and intermediaries and LPs and GPs.
Great, thank you. So on the other side of a capital provider is somebody that needs the capital, and we talked about that a bit. So these are individuals or institutions, whether they're companies or governments. So sometimes roads need to be paved, and therefore we are a user of capital. Sometimes new products need to be developed, and therefore they would be a user of capital or a needer of capital. And therefore capital users can be lots of different types of institutions, but they're essentially folks that need capital, and they need to use someone else's capital because they don't have enough resources on their own, or they would like to use their other resources for something else. As we talked about intermediaries are the third party that really sits between capital providers and capital users. And there are lots of different types of intermediaries. Banks are probably the most representative ones. And then there are also insurance companies and some investment managers. And then last thing I wanted to mention to you is this concept of an LP versus a GP. So a limited partner versus a general partner. And this is, you'll often hear this if you read the Wall Street Journal or you listen to CNBC. General partners are usually investment managers, but they're typically investment managers that manage capital in the alternative assets, not the traditional assets. And we'll talk a little bit more about what that means. And the limited partners are simply the clients of a general partner. So general partner is the actual investment management manager, limited partner is the client. And so with that, there are lots more terms that one could define. And maybe I would suggest, as Randall said, look at Investopedia. There's also a Barron's dictionary of financial terms that's about yay thick, and it is actually a very, very good a resource if you plan to interview in investment management, or if you just want to be smart about managing money and understanding the capital flows around the world. So with that, we will go to the next slide and really talk about asset classes. So here's where I talked about traditional asset classes versus alternative asset classes. Fixed income and equity are more traditional asset classes. When you think about stocks and bonds, those are the things that typically, generally, people understand what they are and will lump in cash with fixed income. Those are traditional assets. Alternatives, what you may hear are more sexy, splash in the newspaper, are alternative to the traditional. They are asset classes that maybe are less correlated to the public equity markets or the public bond markets. Hedge funds are certainly less correlated or designed to be less correlated. Commodities maybe it can typically be less correlated. Commodities, whether it's gold, whether it's corn, whether it's oil, there are lots of different commodities that folks can trade on and that are considered alternative investments. Infrastructure, whether it's a wind farm in Mexico, or whether it is a road down the Autobahn in Berlin. There are lots of different examples of infrastructure. We use public infrastructure every day. You used it at some point today, whether it was support for the plumbing that you used or the road that you drove on. So there are lots of different examples of infrastructure. Real estate, we all pretty much know what that is, but did you know that there are so many ways to classify it? Whether it's core, core plus, value added, opportunistic, these are different types of ways to describe risk within real estate. And then in real estate, there are also different property types. Multifamily, which is basically apartments, offices, industrial, retail, hotel, lots of different real estate asset classes that we can think of. Within venture capital, I'm sure you guys all have heard of venture capital, given the technology boom that is among us today. But venture capital is essentially investing early on in a company's life, whether it's at idea, whether it's at first launch of a product, or whether it's as that product grows. All of these are venture capital investing into companies. Private equity, that's typically more mature companies when we are using leverage or credit to buy a company out and expecting to grow it and sell it at some other price or a higher price. Similar to real estate, buying low and selling high. That's essentially the business of private equity. And private credit is somewhat akin to fixed income. As you see on the side of this page, there are lots of different types of ways of investing in fixed income, whether it's corporate bonds, high yield, non-US bonds, or even US municipal bonds. Private credit may invest in different types of those of that fixed income, or it could essentially be privately lending to companies or to projects or something like that. So I'll give you an example. If I was an institution, the loan that I gave to my brother last week would have been called private credit, but I'm not, and it wasn't a formal loan. But essentially, that's what it is: a GP lending to something, investing in some type of debt product in order to create an outsized return. And then last, we have cryptocurrencies, which I'm certainly not an expert on, but certainly that is an emerging type of asset class and an emerging opportunity that some people can invest in. So asset classes, whether they are traditional or alternative, there are many, and there are so many investment managers that are focused on each of these asset classes. And, you know, as you heard me go through the alternatives, there are so many layers and types of each of these classifications. You could probably go down 2-3 layers on each one. So there's a lot of depth and texture to the asset management industry or investment management. And part of that comes from the various asset classes that one can invest in. My firm, Clearlake Capital, invests in private equity. Randall, your firm invests in how many of these asset classes? Tick through them for us.
Yeah, so I was going to say, basically, we cover everything from fixed income, equities, basically everything in alternatives we're building out. So we have basically everything on the alternatives list aside from private credit, and that's actually being made, and crypto, which are actually being made, and actually was just added to my core focus was cryptocurrency. So I do a little bit of research on crypto every now and then. Not every now and then. I'm actually a pretty big crypto nerd. But hey, if you want to talk about it, just message me offline. And my shop is actually known more for their bonds management. Beforehand, we recently diversified into more equity-based alternatives, and I mean, it's worked out pretty well for them, and they've been doing pretty well with it. And I mean, the firm has been amazing in regards to getting into each asset class and making sure that at the end of the day, all asset managers want to have as much exposure to each asset class as possible, because it's another method of like revenue generation for the firm. And also it's just another way to provide exposure for our clients themselves to other methods of hedging.
Sure. I would correct you there, Randall, because not all firms want to do everything, but certainly firms like Wellington like to do a lot of different things. And there are lots of firms, JP Morgan, Wellington, PIMCO. There are lots of firms that have lots of business units and can invest in lots of different things. But some firms, some of the firms that are affiliated with UNCF Lighted Pathways do one thing, and they do one thing really, really well, and they're specialists. And both paths are okay. It is okay to go to a specialist. It's also okay to invest with or work for a firm that likes to invest across the asset classes. There's lots of ways to make money. It's like pick one. So we'll move on from asset classes to the next slide, but understand that this industry has a lot of depth to it, and there are lots of different ways that one can invest and build a career. So speaking of careers, we're just going to touch on the different functions in investment management. When people think about investment management, a lot of times people think equity portfolio manager. That's it. I'm going to manage a portfolio of stocks, and they're going to be stocks like Walmart or Siemens or something like that. But actually, there are so many different career paths within investment management, because there are lots of people and lots of parties that need to do a bunch of functions in order to make things work. And so if we think about the primary role of an investment manager, it is to complete investment analysis or due diligence in order to make investments. And so that is kind of the primary role within investment management industry. But as you can see on this page, the ancillary roles, even from the beginning, whether regard to asset allocation, the mix shift of those asset classes in a portfolio, and portfolio construction, those are all very important roles within the industry as well. And so if we take kind of from the top of investing, figuring out how we're going to invest and what we're going to invest, and then go down the food chain and think about what does that take, it requires investment research, a lot of which is done by Randall. He spends his time really thinking about what is important within an investment, what are the challenges, what are the opportunities, what are the strengths, what are the weaknesses of any given one opportunity, and really distilling that so that he understands everything about it. That requires qualitative research, that requires quantitative research, that requires talking to people, that requires doing research on your own. And so investment analysis and making investments and doing investment research are all a big part of roles in the investment management industry. I'd also mention investment consultants, one of which is Cambridge Associates. It's right there in Boston. And there are many investment consultants around the globe and across the country. Those folks are really tasked with working with capital users and capital providers to direct them and guide them on topics of asset allocation, investment analysis, portfolio construction, and investment research. So investment consultants do all of the above, whereas I think, investment managers are typically most focused on investment analysis. I will pause here and see if Randall has anything to add.
Yeah, no, for sure. And I mean, when it comes to going through investment research, there's so much that has to go into the actual investment decision, the actual, hey, we're going to allocate capital to this company. And it's all, like she said, qualitative, quantitative, and really with how we do it, it's one of those things where we actually have three points of contact, where we have the trader, we have the portfolio manager, and then the analyst, right? And so we actually have it where the analyst either covers an industry, so either vertically, they'll cover an entire industry, or they'll go horizontally across the entire equity markets and only focus on certain classifications of it. So like mid cap, small cap, large cap stocks, all that stuff. And so when you're understanding these, well, not even these different facets, and having a focused and specialized outlook, like she was mentioning earlier, having a specialized outlook and having a singular person focused on that specialized outlook, it provides even more robust and enhanced investment decisions for our investors, and make sure that, like, for me, I have to understand the entire payments industry. That's literally my goal. And I know that whoever I'm communicating with, either it's the portfolio manager for the entire mid cap, or it's the portfolio manager for the entire large cap, I have to know everything about the industry itself, no matter what the security is classified as. It could be mid cap, small cap, all that. Private equity. I just have to understand each facet of that. But then also going into the tools that we utilize, like the financial data vendors, the financial news services, the credit rating agencies. These are all things like Bloomberg is your financial data service, well, your financial data vendor, or FactSet, if you've never heard of that as well. Financial news services, your Wall Street Journals, your, again, Bloomberg's, CNBC, MSNBC, all that stuff. Credit rating agencies, S&P, State Street, Moody's. All these companies are implemented into the actual investment research process, because we have to utilize either those credit ratings. I used to work in high yield credit for an energy company. We utilize a lot for credit rating agencies. We utilize the Moody's for really ranking a lot of the actual bonds in the industry. So there's a lot that goes into the overall investment decision process. And then risk management, like risk is an entirely, like, how do I say, it's an all-encompassing thing in the investment management industry, because we aren't just people who are risk takers. We are people who are trying to optimize risk. We're risk mitigators. We are people who are trying to make sure that for every opportunity of risk that we're taking, for every dollar of risk that we're taking, we are maximizing the returns associated with that investment. That is the absolute best investor you can be, is being a great risk mitigator, where you can take a whole lot of risk and get the exact amount of return associated with that risk, all diversified away. So that's one of those things that we look to do, especially in that risk management process. And ESG has been something that's on the rise. If people are very aware of what's going on with the environment, social governance, social and governance, you guys all have another say. There's so many facets into the investment management industry. I used to work in ESG as well. I used to do climate research, and I worked with PhDs in climate science. And so, like, there's so many different aspects you can get into when it comes to the investment management industry as a whole. And it doesn't matter where you really came from. There's always a spot somewhere that you can generate alpha from. So that's kind of what I really want to say about that.
Yeah, no, that's a really great point. And I think the goal of this slide is really to show you, as Randall said, there are many, many ways to access the industry if you are interested in a career or a first-time job that touches the financial markets. And it doesn't have to be at an investment management firm, but it can be. It can be within financial data, financial news, credit ratings. Those are outside financial services firms or outside investment management firms. But inside financial services firms and investment management firms, You can do the investment management, you can do the investment research, you can do the analysis, but if that doesn't seem to suit you, there are other roles. Like Randall mentioned, from ESG down through custody and everything in between. For me, I was never interested in doing investment analysis, never interested in the job that Randall does. I was more always interested in portfolio construction, asset allocation, and I was also more interested in engaging with clients and selling to them and building relationships with them. And so marketing and sales has been where I've spent a lot of time, in addition to asset allocation and portfolio construction. So depending on where your interests are, depending on where your strengths are, you can pick an opportunity within the industry that fits you. And by the way, you know, the financial services industry and the investment management industry are those that are kind of on the high income earning list, regardless of the function or the role that you choose. So we'll leave it with that, but know that there's a variety of opportunities within the industry for you to become better endowed into the investment management industry and to learn a lot. So with that, maybe we'll go to the next slide. I think that we are ready to talk a little bit more about our paths to where we are today, but also to answer questions. These are questions that if you guys are interested in knowing about us, we're happy to share. But more than that, we really want to make sure we're answering your questions because I think we've got about 15 minutes left. So I'll pause and I'll say, Randall, why don't you kick it off and tell us why you like the investment management industry? Why, of all the opportunities that you had graduating from Florida A&M, did you choose where you are today?
So, I mean, are we going to go the full story? Because I can go the full story. I feel like
Not the full story, boy.
All right. So, long story short, I had this affinity. Actually, was originally a computer science major, transferred over into finance. Was not because computer science is too hard for all you guys who want to say that, okay? No, I actually enjoy computer science a lot. I still program to this day, but I actually just had this love of finance. And I read this book by John Bogle in regards to Little Book of Common Sense Investing, my all-time favorite investor, actually, just in case you didn't know. So John Bogle, he's the guy who founded the index fund, the guy who founded Vanguard, basically the creator of everything that is generating alpha right now. So yeah, when we think about how I got involved in the industry, I actually originally messaged a bunch of CEOs and CIOs of investment firms and said, hey, I'm a kid. I don't have any internship experience. I don't have any kind of finance background, and I'm interested. So can you give me an opportunity? And long story short, they gave me an opportunity. So I appreciated them. The CIO of Vanguard currently, Greg Davis, he's a great friend of mine. And he actually got me connected to the head of fixed income trading, the head of FX trading, and kind of jettisoned my career into the finance industry. This was my freshman year within the school business. Well, actually, not even school business industry. I was still in the computer science program at the time, but at FAMU. But I actually matriculated through that program, figured out that I truly loved finance and everything that has to deal with finance. And so I pursued another opportunity with Wellington. And I actually went up to the booth at our career fair. And I was like, hey, isn't this the firm that John Bogle used to work at? And they were like, wow, you knew that? I was like, yeah, no, I read this guy. You know, small facts like that. They're like, okay, go ahead. We'll interview you. We have interviews tomorrow. I was like, okay, interviewed. And again, long story short, I got the role and I've been working at the firm for the past 2 years. Why I really love finance is that it's a way for people to really make dreams a reality. That's how I always view finance. It is a method for providing capital to people who have dreams and making those dreams a reality. And that's always going to be my motivation for why I make sure that I try to steward capital, especially into underrepresented communities, aka the Black community, but making sure that I am always focused on that and making sure that that's a primary goal of mine in regards to making sure that I can make everyone's dream a reality. So yeah, that's how I got started.
Thank you, Randall. And maybe I would share a couple of data points for you so that you guys can better understand Randall's point around funneling capital to folks that look like you and me and that need it. So the financial services, or excuse me, the investment management industry is a $69 trillion industry. $69 trillion. Today, less than 2%, more like less than 1.5% of those dollars are managed by diverse owned companies, whether that's women, whether that's Black folks, whether that's Latinx, whether that's veterans or disabled folks. Less than 1.5% of $69 trillion is managed by diverse owned firms. Now, you might say, well, there are lots of people that work in the investment management industry. What about them? What I would say around ownership is when you own a firm, when you own where the dollars go, you control where the dollars go. Very similar to Randall's point. You control where dollars go through proxies for public equities, through bonds and where you're going to loan capital, through ownership. As a private equity owner, I get to decide who gets my capital. I can decide who's on boards. I can decide who's the management team. And if the management team is full of a homogeneous set of folks or it's diverse. So I just want you guys to remember and understand that as you own things, you control things. And if we are not represented in the investment management industry, we can't control much of the capital flows around the world. We can't decide if capital goes to here, or here. We can't decide that just because somebody's Black, it doesn't mean that the risk is high. We can decide and we can do the analysis that no, that's not the case. They have a really great idea and we're going to invest in them because the risk return opportunity is right. So I think that part of my interest in the investment management industry, even as a young person, was to understand how capital flows around the world and to have my fingerprint in it and to be able to help control that, whether it's through the dollars I raise or the folks that I work for, and knowing that they are backing folks and controlling capital in a really strong stewardship way. And so that was my interest in the financial services industry and investment management. And it's not too dissimilar from Randall, just said in a different way. When we understand the way capital moves, we can control it. And when we can control it and we can own it, then we can make really big things happen. And so I will step off my soapbox and then I'll see if you guys have any questions. I know there was a question about the repo markets, but are there any other questions? Looks like Gabrielle has one, and it's what does financial management look like from an entrepreneurial standpoint, possibly as a part of a consulting firm? So, I think that entrepreneurs in finance there are opportunities if we think about that list of functions within the investment management industry. Most of those functions can be served by an entrepreneur. They don't have to be captive within a company, but certainly there's some that are more often served by an entrepreneur or more served by a company. So Akila, can you go back to that page around functions in the investment management industry? Okay, so any of these folks can be entrepreneurs. You can be a service provider to a company. If you are really good at risk management, you can be a risk management consultant and be an entrepreneur providing your analysis around risk to financial services firms or to investment management firms. You can be a third-party marketer and you can sell. Yeah. You can sell on behalf of a company. So there are lots of ways that entrepreneurs can participate. But I honestly, you do see fewer entrepreneurs within investment management unless they are owning their own firms. They are owning their own investment management firms. You can do other things, but more often than not, people start up their own investment management firms to focus on one or more asset classes and generate strong returns for their investors.
Yeah, I was going to answer Zion's question earlier.
Please.
Yeah, can I actually, Randall, well, first, Randall and Marcelia, thank you guys so much for taking your time to come speak with us. Very informational. And just a little bit more clarifying, because I learned a little bit more, Randall. So pretty much I was asking, now I did a little bit, I backtracked a little bit. I'm at investment bank right now, so that's why I kind of understood the question. So with the market and everything, what type of collateralized securities do hedge funds normally like borrow against? And what I'm really trying to get at, because you said you're into crypto, do you think there'll be a shift towards like maybe a stable coin? Because we are really looking for like a stable, collateral, like stable, like I guess security. But investment banks, whenever they hear crypto, they all put it down to one market class. But you said you're developing and into the space. So how do you think that looks like in the future? Or is there no future?
Gotcha. No. So first off, I mean, your question, sorry, can you repeat the first part of your question? I was listening to the crypto. I got a little excited.
I feel you, bro. I feel you on that. I was pretty much saying, what type of collateralized securities do hedge funds typically borrow against? Got
it. So yeah, no, collateralized securities that hedge funds can utilize. I mean, it depends. It depends on the firm's investment philosophy in the first place. But I mean, collateralized would just mean something that's backing it. So you could have a home. It could technically be a business itself. You could collateralize it on the future revenues of the business. You could collateralize it on other assets. There's a lot of financial instruments and things that could be created to collateralize on. So when you're thinking of the markets themselves, like the most known one would be like CLO, collateralized loan obligations, or just your overall, like your mortgages, like collateralizing through mortgages. So when you're thinking about mortgage-backed securities and stuff like that, it's obviously collateralized by the mortgage itself on some sort of asset, and you could utilize credit swaps. You can utilize other financial instruments to generate alpha on those securities themselves. To your second point, I mean, crypto, like as a whole, I mean, I love it. I mean, I can't push it onto everybody. I think that it's one of those things that is developing. It's going to exist for the next couple of years, and especially in the stablecoin markets. Like I focused on Circle, Terra. Like I know Terra blew up, but a couple other stable coins. I actually focus on stable coins most more than anything because we work on making sure that use cases are the top of mind. We're not really NFT focused in nature. So we're kind of like, hey, how does this generate value? When we see how like cross-border transactions, I mean, I don't know if you keep up with CBDCs, but we're trying to estimate how CBDCs will impact stablecoins and stuff like that. And overall, I mean, it's a great instrument to be utilized, but it's just not developed enough yet to be widely produced or distributed to the masses.
So you feel like even if like those stable coins are backed by real securities, that it's not because it's theoretically the same thing if you think about it. Like if a stable coin, I think it's not Terra but Tetra, like the T coin, they're backed against actual bonds. You know what I'm saying? So if you just collateralize a collateral like security already in a way, does that make sense? Or
Ryan, should we?
Yeah, I was gonna say, I'll
we take this offline?
I'll
Thank you for jumping in. I was just
We've got
about to
about
jump in.
3 more minutes. We do have a question from Dalen Sims, or a statement. Dalen says, I'm majoring in computer engineering and I want to get into the financial management as a minor, but I don't know what minor to choose. Which minor would you guys choose for the best outlook?
Me personally, I would choose finance. I would choose finance so that you fully understand the financial services industry, so that you understand the analysis that goes into the financial services industry, whether that's the type of quantitative analysis that Randall is doing, or whether that's more qualitative analysis and asking the right questions and thinking about the right concepts. So for me, I would focus on broad finance because it'll give you a broad understanding of the industry. And after you understand something broadly, then you can dive into something more specialized. But you got to have a good foundation to begin with. Any other questions?
See.
Yes, and please feel free to use the chat. I know you all have so many questions for Ms. Freeman and Mr. Leith, but let's keep our conversations and questions as direct as possible.
Yeah, I apologize. I should have definitely.
No, it's okay. It's great. It's great. Our students need it. But just to be cognizant and respectful of everyone's time. Okay, we have a question here by Ariel. How is your work-life balance?
Oh, I can touch on. So, I mean, it depends. I'm sorry to say this, but that's going to be like your answer through basically everything in the financial services industry. Like if you hear it depends, it's an actual valid answer. But I mean, you could be working in investment banking and doing good amount of hours every day. You could be working in sales and not doing that many hours, but doing same amount of work. You could be doing investment management, investment research like I'm doing right now. I have a pretty good work-life balance, if I do say so for myself. But I mean, that's also relative. So when you think about good work-life balance, it's really how you organize yourself overall. Again, IB is a little bit more in the higher hours, I would say, but it is a industry that is developing you as an individual and developing you in regards to your skills and stuff like that. So it's a little bit more rigorous in nature and a little bit more competitive. So if you're not the competitive kind, I wouldn't highly suggest it, but there's always different facets. Like my personal role, it's not very competitive really. It's more so focused on development and making sure that you have well thought out investment decisions. So basically like you can have one end of the spectrum or the complete other. So that's how I kind of think about it.
Perfect.
Maybe
Now,
I'll add in just quickly on work-life balance. I would say if you're searching for work-life balance, you probably don't want to be in the investment management industry. But also, if you're searching for work-life balance, why I would ask myself why work isn't part of investing in myself. So the work. What does that even mean? I personally take the work part and I dive into it and I put everything I can into it because it's an investment in my future, an investment in my today, in learning something new today, in setting myself up better for tomorrow. And so you gotta really think about what are you looking for when you ask yourself, do I want work-life balance? What is my goal? Is my goal to be able to hang out with my friends every night and every weekend? Then, hey, do that. But if my real goal is to be able to invest in myself and learn as much as possible and have a little bit of delayed gratification, then I would say lean into work right now and your life will be exponentially better later.
thank you, Ms. Freeman. We've got one more question. Any book recommendations from you or Mr. Leith?
Sure. So I do suggest that you guys read Reginald Lewis's book, Why Do White Guys Have All the Fun? I think it's an excellent book and one that'll give you a lot of perspective. And, there are other ones like Liar's Poker and The Wolf of Wall Street that are great books, a little bit more entertainment. But that's the number one book that I would recommend to say, why would you think about a career in investment management and financial services? What about you, Randall?
So my book that kind of gave me the epiphany or the realization was the Millionaire Next Door. Actually, was my book that gave me the realization on how I kind of perceive money and gave me a different perception of how I really should move in the future in regards to like managing assets. Also how to look at individuals and how to not make predetermined notions about people. Like, oh, I think that every billionaire is out here in a $1 million suit and tie, right? Not the case. It's really like the people who have the most money are living pretty comfortably, and their style reflects comfort. So that's one of those things that you should always keep in the back of your mind. Like, you never know who you're going to meet. Everyone's an opportunity. So that's how I changed my perception of the finance industry in general.
And maybe the last one that I would share, I think a very good book for you to understand how managers think about things is Steve Schwartzman's books, What It Takes. It's a very, very good book. It's written by the founder of Blackstone. Blackstone is one of the most elite asset managers or investment managers in the world. What It Takes by Steve Schwartzman.
Okay, thank you for those great recommendations, and thank you all for your very detailed presentations today. We were glad to have you, glad to have our scholars on. One housekeeping note, if you have not sent in your headshot to us, the email is cie@uncf.org. Please get those in to us as soon as possible. And with that, we will close out. If everyone will thank our two speakers for their very detailed presentations today, we will go ahead and wrap up, and we look forward to seeing you all next week.
Thank you guys for having me.
Thank you, guys.
Thank you. Okay, everyone, have a wonderful day.
Thank you. Have a good one.
Until next
You
time.
too.
Is that Ellington?